Hey everybody, Courtney Smith here with the November 7th, 2022 edition of Wall Street Winners. Let's dive right in. And we saw the after the Fed meeting, the market took a dive, but it turned right around on Friday and started to resume the uptrend. Now, I'm on record as saying that the low that we made in the middle of October was the low of this bear market that I told you about over a year ago. I called the bear market, we had it, now I'm calling for the bull market. This initial phase is not going to be pretty. It's going to be sloppy and choppy, but that's okay. It'll be a bull market. We're going to make higher highs and higher lows. Having said that, there's still a few problems in this market. Look at the purple predictor breaking to new lows even though the price did not. Now, this is a bad sign. It means the smart money is bailing out. So this makes me nervous. But all in all, as we go through our analysis here, you'll see this is a negative, but price action is quite positive. Dow Jones, the most powerful of all of them. And notice that we got above 70, we sold off, then we've started to rally right back up again. Buying pressure still much higher than selling pressure. So that tells us we're still in a bull market. NASDAQ is the weakest of the three. We didn't break to new lows, but it looks pretty bad. Purple predictor also slightly negative here as well. So mixed bag. Seasonality, really, as soon as we break above these highs, I'm going to flip this to bullish. And when we flip to bullish, then I'm going to add 50 to 100% to the size of our positions. So if we normally would buy 100 shares, I'm going to buy 150 or 200. Why? Because seasonality provides a tailwind. It pushes us forward. It reduces risk. It increases the number of winning trades and increases the size of our winning trades as well. So we're going to go to bigger positions. But first, let's break above this high right here on the IWM. IWM is the Russell 2000. But you can see here we are. We're in the little fade-orama here. We're fading a little bit. There's the low that we made. Now we're going to kind of chop, I think, a little bit sideways here. And then after this 1 week, 2 week period, we're off to the races. And next year, super bullish for two reasons. Number one, seasonality. It's the pre-election year. This is the best year from a seasonal perspective. Number two, the Fed will start to ease, and all that flood of money is going to come in and boost the stock market. Asset allocations already boosted the stock market as bond traders bailed out of bonds and bought stocks. Looks like they faded a little bit here, but nonetheless, the trend is still bullish for money out of bonds and into stocks. And oh, by the way, cash, record-setting cash at brokerage houses. So there's a lot of latent buying pressure waiting to come into this market. It won't come in right away because we're doing the phase in the bull market where we climb the wall of worry. And so we're going to see a lot of negativo stuff in the marketplace. A lot of people are going to be saying a lot of bad things about it. And that's perfect. I love it because guess what? We'll be taking their money while they're selling. We'll buy. We'll take their money. We'll say thank you, of course, and we'll send them Christmas cards as we take their money. Stock market risk indicator, though. The market is moving higher, but not in the sexy NASDAQ stocks. Well, you know that. I already showed you NASDAQ is the weakest of the three major. They're putting it into high dividend paying stocks, conservative stocks. That's the place they're buying. That's why the Dow is outperforming S&P and NASDAQ by a long shot. And of course, that's where we want to focus our attention. Global shares stronger than the NASDAQ, but weaker than the S&P. Interested in buying, but right now Dow stocks are where the action is. My job is to make money. I go where the action is. Yield curve continues to move down. We've got ourselves a recession. Just don't even think about it. But the recession is bullish for stocks. Not yet, because we had 2 quarters of negative growth. Last quarter was positive. We're going to go back into negative growth here. The yield curve has predicted it, and it's always right. Look in the lower left-hand corner. Now, even short-term interest rates are way up there. The Fed has gotten to the point where they've raised interest rates enough that they're now above many of the longer term interest rates. This means the early part of 2023, the economy is going to be awful. Earnings are going to continue to collapse in the stock market, and that's bullish for the stock market. Because we've already discounted the recession, now the market will have to discount the resumption of economic growth caused by the Fed easing monetary policy. That's what we're doing right now at the very beginning stages of that. Remember, the market doesn't reflect what's happening today. It reflects what's happening in the future, 3 to 12 months. I kind of use 6 months as an estimate. And so the market's saying that we're going to see the Fed start easing around May, something like that, second quarter of next year. And then the bull market will really take off. But of course, we've already positioned ourselves beautifully by buying in within a day of the low of the market. Bonds, I think we're going to head lower. Purple predictor has collapsed over here, got a little bit of a rally, and then collapsed again. So I think we're going to see bonds continue to move lower, but we're reaching a bottom. We're not going to go too much lower here on the bond market, so there's not a lot of downside potential. I thought about shorting bonds, and then I passed on it. Bond key factors. Here's one of the reasons why. The short-term factors right here, that's the 10-year Treasury yield, and that is the German 10-year Treasury. They're both skyrocketing. But in the background, we have the chart itself. That is the CRB index. That's the Commodity Research Bureau index of commodity prices. A mini bear. Then we have gold down here, significant bear. When both of them combine, which occurs right here, this is when both of them start a bear move. 6 months after that, we will see interest rates start to come down. And of course, 6 months from July, that would be August, September, October, November, December, January. So in January, they're saying probably that, I'm saying in January, February, somewhere in that area, we're going to start to see 10-year treasuries come down as the bond market starts to discount the coming Fed easing that will be triggered by the recession. Okay, you got the whole sequence of events here. I laid out the timeline for you perfectly. Write it down, see if I'm right. Dollar, I'm not excited about the dollar anymore. You know, we were the big bulls in the dollar. I'm not excited anymore. Why? Because other countries are starting to try to catch up with the Fed. So the dollar's not going to be as bullish as it has been in the past. That means that gold can finally start to put in a bottom here. Notice we've got a bottom, and a bottom. We got a triple bottom here. We broke above this little mini high. If we break above this high, then I'm going to start to get excited about getting long gold and gold stocks. This line right there, just right up there around 1740, I'll be bullish. But until we get there, there's still a little bit of headwind going on here. Our gold indicators remain neutral. So why get involved in a neutral market? It's boring. We don't make money. Crude oil and all commodities are starting to perk up a little bit, being led by energy. And in fact, I'm going to be getting long more and more energy stocks again. But here we made a higher low. We're about to make a higher high. Purple predictor is bullish. I'm back on the bull side of crude oil. Not that we're going to 120, but we're going to go back to 100 for now. Bitcoin, look, we're making higher highs and higher lows. I mean, if we break that high there, then we're making higher highs and higher lows. I got out of my short positions in Bitcoin, made a microscopic amount of money. Don't want to go to the bull side yet, but I'm getting close. Once again, Bitcoin is inflated by Fed policy. That's what drives it. That's why we had the big bull market in Bitcoin last year, is because the Fed was drunken sailor on a shore leave. So they were just spending money. The government was spending money. And when you see the federal government spending trillions of dollars that it doesn't have, and when you see the Fed pumping trillions of dollars that they don't have into the economy, you get inflation and you get bubbles. Bubbles in the stock market, bubbles in Bitcoin, bubbles in the dollar, bubbles in real estate, bubbles in M&A activity, bubbles in SPACs. You got the picture? That's all gone now. That's all gone. All those bubbles are gone. We're about to get back to reality in all these markets. We need to take out a little bit more of the bubblicious effect that we had from the Fed, but we're getting close to the end there. We may have already reached the end in Bitcoin. I thought we'd get down to 10,000, or really under 13,000. We might not. So tentatively getting a little bit bullish here. All right. That's where we're at right now, freebies. You've got to be signing up. You're just being foolish, not making money. I know it's great. You like to hear my cherubic voice. I know you like to see all the cool indicators we have. You like seeing me call the market perfectly because nobody else does, of course. Just me. I'm unique. But you really should be making money from this stuff. All right, freebies. We'll see you next week.